So I'm here this morning to talk to you about Asia, and I hope you enjoy the presentation, and I look forward to your questions at the end. So to start out, if you take one thing away from this morning, I want it to be that now is the time to invest in Asia. 2018 was a difficult market for Asia. There were a number of reasons behind that, which you'll see going through the presentation, but all of those issues are starting to turn around now. For one thing, last year, the Federal Reserve in the US was raising interest rates, and that creates an environment which is difficult for emerging markets, including Asia. But that seems to be on hold now. Secondly, as you all know from reading the newspaper, there's a trade war raging last year, and it was escalating throughout the whole year. That now seems to be de-escalating, and there is decent hope that a trade deal is going to be negotiated before the end of March. Thirdly, there were some issues with the Chinese economy domestically that were outside of the trade war. Those are going to be addressed by policy in the coming months. And then lastly, there was stress globally in the technology sector, whether it was the FAANG stocks or the BAT, that's Baidu, Alibaba and Tencent in China. There was stress in technology, and technology is a core part of Asian markets and of our portfolio. So when you add all those things up, it's not surprising it was a difficult year for Asia, but as you'll see throughout the presentation, this year is looking a lot better. In terms of I want to draw your attention to the chart on the right-hand side. What we did was we looked back at all the major corrections in Asian markets since the late 1990s. So I started working in Asia during the Asian crisis in 1997. I was actually an investment banker in New York, and Korea was in really big trouble. So the staffer said to all the analysts, "Who wants to go to Korea and work on this deal of the Asian crisis?" Nobody put up their hand except for me. So that's how I started my career in Asia. But you know, the Asian crisis was a terrible time in Asia. But once it bottomed, the rebound was very, very sharp. And if you look at all these other corrections, whether it's the tech wreck or SARS, the GFC, RMB devaluation, after Asian markets have a bad year or a bad time period and they bottom, the rebound is very sharp. So on average, the rebound is about 54% in the year after. So we are hopeful that 2019 will be a strong rebound year. When we look out into what's going to happen in Asian markets in 2019, it can kind of fall into four categories. One is the impact of US rates and the US dollar. The second one is trade war de-escalation. Thirdly, China domestic stimulus. And lastly, the BAT and the FAANG stocks. So let's go through these one by one, just so you see how we're thinking about Asia going into this year. So the first one is about emerging markets as an asset class. There's a lot of money that flows in between developed markets and emerging markets. And typically what happens is when US rates are rising and the US dollar is appreciating, money flows out of emerging markets into developed markets, particularly the US. And this happened very clearly in 2018. You can see by the chart on the left-hand side, that inverse relationship held almost perfectly. So you may be asking, well, why is that? Why does that always happen? And there's a couple of reasons. One is because when rates are rising in the US, the differential between what fixed income investors are getting in emerging markets and what fixed income investors are getting in developed markets or in the US, that differential closes. And so some of that money goes back into developed markets. The second thing is that in many emerging markets, a lot of companies have US dollar debt. So as the US dollar rises, it becomes more expensive for them to service that debt, and those companies may get in trouble, and then the equity markets go down. The third thing that can happen is that I'm not the only person in the world who can do this chart, right? So people know when US dollar is rising and US rates are rising, that this relationship is going to hold, and so it becomes self-fulfilling prophecy because you know, people know that that emerging markets are going to go down, and so they try to front-run that. So this happened last year, but if you think about what the Fed has said recently, back in November, December, Chairman Powell said that the US economy was near neutral, and at the time a lot of economists still had multiple rate rises expected for 2019. I think right now the dot plots are still expecting a couple of rises in 2019, maybe one or two, but when we talk to our global macro team and economists around the world, the market seems to be pricing in no more rises. So it's quite amazing that the world has gone from multiple rate rises in 2019 to no rate rises in a short period of time. So if there are no more rate rises in the US, that inverse relationship will hold on the other way, and you should see a lot more money flowing into emerging markets. That has happened year to date in 2019. And then the chart on the right-hand side shows what is the impact of Asian markets performing poorly last year. the sum of what happened is that Asian markets are now very inexpensive versus developed markets. So MSCI Asia ex Japan, which is my benchmark, is trading at 11 times PE, but growth is still very high. So to be paying 11 times for very high growth rates is quite inexpensive from a what you're paying for growth perspective. And then look at what you're paying in developed markets. So you know, the Nikkei, it's a significant premium to what you would pay in Asia. And then in terms of the Australian market, obviously that's very expensive and there's no growth. So we think that from a valuation perspective, there's a very strong case to be made for investing in Asia right now. Some of you who are you know, very seasoned investors may say, well, it's difficult to look at PEs at market inflections because the earnings could be wrong. And that is a totally fair point. We actually agree with that you know, because of the trade war and different things, there's not a lot of earnings certainty at the bottom of a cycle. So what we do is we look at price to book because that's a much more stable measure. So we looked at how many companies in Asia are trading below book value. And at the trough, it was almost 30% of Asian companies were trading below book value. And that as an overall valuation metric seems very inexpensive. So at the end of last year, around October, November, we started investing more of our cash back into Asian markets, and that's been the right thing to do. They've recovered quite significantly since the low at the end of October. So I'll just give you a quick update on our views of the trade war. I know a lot of you are in businesses that are impacted by trade, and I'm certainly in a fund that is impacted by trade. So during last year, we had always outlined that there were three possible outcomes in the trade war. The one was just tit-for-tat escalation. So that is the picture of Trump and Xi banging each other over the head with different levels of tariffs throughout the year. And that was frustrating because you know, markets don't like uncertainty, and that tit-for-tat back and forth with different levels of tariffs created a lot of uncertainty. The news about that scenario, though, is that you know, the math of tit for tat is pretty much over. So if the US were to impose the tariffs on the additional $200 billion, they would have tariffs on every single thing that China imports to America. So they can't really retaliate back. China, because of its different economic and deficit with the US, or surplus with the US, means that they have also run out of room. So tit for tat has sort of run its course. We don't think that can go any further. In terms of extreme retaliation, we have never thought that this is going to go to extreme retaliation phase because it would just be far too damaging for both economies. So what some economists were thinking were that you know, there was weaponization of the Chinese currency, and what that means is they would just depreciate it quite significantly to counterbalance the effect of the tariffs. That would be a very dangerous move because you would get capital outflow from China, and that would cause a lot of other problems. There was this theory going for a while about getting the whole world to gang up on China, and that Trump could go around and get the EU and Japan to also be very negative in terms of trade on China. We didn't think that would happen because it would be detrimental to the European and to the Japanese economy, particularly Japan, given its proximity. So a lot of these sort of doomsday scenarios about the trade war, I personally never thought they were going to come to fruition, and it's pretty clear now that you know, there's a very low probability of the world going that way. So we're left with negotiated outcome, and this has been our base case all along, and given the news last night, it looks like this is what's going to happen. So if you remember last year in November, Trump and Xi met in Buenos Aires on the back of the G20 meeting, and they agreed for a 90-day moratorium on additional tariffs, where they were going to negotiate, try to come up with a negotiated deal. So that 90 days expires on March 1st. And since then, there actually has been a significant amount of progress made. So the US team went to China earlier this year. Then the Chinese team went to the US, and Trump actually met with that team, which is quite a significant thing because President Xi wasn't there. So usually, you know, you have to meet with your equivalent from the other country. And so the fact that Trump went and met with the Chinese delegation and President Xi wasn't there appears to be a commitment to getting a deal done. And right now, actually, there's a Chinese delegation that's in China. Mnuchin and Louis He, who are the two sort of main negotiators, are meeting on Thursday and Friday of this week. So there's a lot going on. And the news overnight was that Trump and Xi probably won't be able to meet before the end of February when the deadline is. So Trump has said he's willing to push that deadline out, and they can meet sometime in March and hopefully get the deal signed. So we're quite hopeful that there's going to be some sort of negotiated deal. Will it solve all the trade problems between China and the US? Definitely not. Taking a longer term view, we think that This trade war was never really about trade. It certainly wasn't just about the trade deficit. It's more about the hegemonic decline of America and the rise of China. So that longer term issue is not going away, but in terms of market certainty, and for me as a portfolio manager and for my analysts as analysts, at least we can sit down with our models and model something out. Last year it was that there was so much uncertainty. If you had a company that exported anything or imported anything, you didn't even really know what to put in your model. So it'll be quite a market positive if and when this deal does get done. So let's talk a little bit about China stimulus. I am an economist by training, and I personally don't get why China didn't stimulate about 6 months ago. They knew that this trade war was going to be detrimental to their economic growth. They have a very full toolbox of policy optionality of things to do to stimulate the economy, and yet they didn't. So the economy has slowed down, and I think now there is significant incentive to get this trade war deal done and to actually stimulate the domestic economy so it doesn't decelerate any faster. So what can they do? When I say China has a lot of policy optionality, what are the options? First of all, unlike the developed world, which Europe and Japan are still in QE, the US has just managed to drag itself slightly out of quantitative easing. China and the rest of Asia has very high interest rates, so they can cut the base rate. They can also cut reserve rate requirements. This is kind of a specific thing to China. It's like how much money the banks have to keep on the balance sheet for how much they lend. But obviously, if you have a high reserve rate requirement, that reduces the money multiplier for Chinese banks. So they can cut the RRR significantly. Some economists are anticipating between 400 and 500 basis points this year. So that would be stimulative. They have industrial policy. Some of you may have heard of China 2025. This is China's industrial policy going forward, and they have these core sectors, particularly technology, where they want to become world leaders. They can tweak the property sector. In many of the major markets in China, there's been macroprudential and different regulatory things in place to keep prices from going up, but they can tweak that so that property comes back. So there's something they can do on the industrial policy. And then lastly, there's the currency. So the Chinese currency is not free floating. And while I don't think a massive depreciation would be helpful, they can use that as a tool to sort of help on the margins, what's going on with the Chinese economy. So for those of you who follow China closely, you'll know that there's these 2 sessions coming up at the end of February and early March. This is when China makes a lot of the policy decisions for the year. And we're expecting some policy loosening to come out of that, whether it's an RRR cut or some announcements on fiscal stimulus, particularly in infrastructure. Those are probably the 2 most likely. So the point of this page is China's not going to let the economy hard land, and they have enough policy optionality to make sure that that doesn't happen. Okay, BAT, FAANG, and factor rotation. So tech is one of the 3 core sectors in our portfolio. Tech, financials, and consumer are the 3 core sectors. And tech is actually my favorite sector. It's the thing I like talking about the most to investors because Australian investors don't have that much exposure to tech. Actually, a sort of embarrassing thing happened to Sam and I one day at a lunch, and I was going on about how there's so few tech in Australia, and the tech that's here is massively expensive, and you have to pay 65 times PE for very little growth, and I actually feel quite strongly about this, considering some of the tech companies you can buy in Asia. And afterwards, this gentleman came up to me and he said, "Thank you for your talk. I'm the CEO of one of those really expensive, overpriced Australian tech companies." And I was a bit embarrassed, but he said he actually didn't disagree with my comments on valuation. Anyways, tech, if you want exposure to tech, Asia is a great place to get it. And particularly at these valuations after the sell-off last year, tech looks very attractive. So what happened to tech last year? One thing is, remember the chart at the beginning that showed emerging market outflows and the US dollar going up? Tencent, for example, is by far the largest weight in emerging market indices. And so when you get passive outflows out of emerging markets, companies like Tencent that are big and liquid, they tend to get disproportionate amount of selling because it's big and it's liquid and it's easy to get your money out from that. So one is just that tech are big weights and flows were going out of emerging markets. The second thing that happened is globally, this is not just in Asia, there was factor rotation from growth stocks into value stocks. So people were getting concerned about where the market was going and wake up in the morning, they didn't want to be holding stocks that are trading at 30 times PE. They'd rather be in something that's an inexpensive PE with a high dividend yield because it feels safer. So there was rotation out of high PE stocks, like tech stocks, into low PE, high dividend yield. My personal view, we were talking about this last night, is that there are not that many fund managers who actually like to own value stocks. They don't fall in love with value stocks, and can't wait to hold this 4 times PE, highly indebted, asset-heavy, no-growth steel stock in China for the rest of my life. Nobody thinks like that. I personally would way rather hold a Tencent or an Alibaba, which are high-growth, asset-light, high free cash flow, net cash kind of companies. But there was that factor rotation, and I think that rotation into value is they're kind of value tourists. So they're just there for a little bit, and as soon as they feel comfortable going back into the high growth stocks, they'll go back there. And you've actually seen that factor rotation reverse early this year. So the other thing that happened to tech was that Apple was in a bit of trouble. Those of you that follow US market closely, obviously Apple sales slowed down quite a bit. There's a lot of negativity out there that maybe iPhones are saturated in the world. China was one area in emerging markets where iPhones were not saturated, but with the trade war and the Huawei issue, some Chinese consumers sort of retaliated against Apple by not buy, or they retaliated against the Huawei situation by not buying Apple. So anyways, a lot of the tech companies in our universe are Apple supply chain companies, and we didn't feel comfortable buying them when you didn't know what was happening with the trade war and whether there'd be tariffs imposed on components from China, and also we didn't know what was happening with the outlook for volume growth from Apple. So last year we had no exposure besides TSMC to Apple supply chain, but that's typically a big part of tech investment in Asia. The good news is almost all these things have reversed. The emerging market flows are reversing, as we discussed before. Apple's fourth quarter earnings were not as bad as people feared. The trade war is de-escalating, so you don't need to worry that these component companies are going to have to pay 30% tariffs on whatever they're exporting to the US. And in terms of the PEs, these stocks derated quite significantly last year, and so the PEs looked a lot more attractive. So right now I'm positioned quite heavily in tech. Our biggest position is Alibaba at around 9% of the fund. The second biggest position is, the first position is Tencent, around 9% of the fund. The second biggest position is Alibaba, which is around 7% of the fund, and we're also overweight Samsung and TSMC. So those are the 4 mega cap Asia stocks in tech stocks in Asia, and we're overweight all of those. So we're quite excited about tech right now. I'll just comment a little bit on India. The way we're positioned, China is the biggest overweight, but India is the second largest country overweight. And for those of you who have met with Ellerston Asian Investments before, India is always overweight. India on a 10-year view is by far my favorite country. If someone said, put your kids' college fund in one country and you can't look at it for 10 years, I would definitely pick India. So why do we like India so much? The first thing is that it's a structural growth story. So Asia as a whole region is a structural growth story, and within that, I think India is the best structural growth story. So what do I mean by structural? Structural is the opposite of cyclical. So obviously you can get countries that get cyclical growth, like the US would be an example. The underlying growth rate is relatively low because it's a developed economy, but you get QE or you get Donald Trump coming in and cutting taxes and doing fiscal spend, and you can get a boost in the growth rate. Countries like India are totally different. The growth is driven by the rising middle class, the demographics, which are extremely attractive. So, India has 1.2 billion people, and by 2030, it's going to have more people than China. But the amount of attention that's paid to the Indian consumer versus the amount of attention that's paid to the Chinese consumer is a big differential. The demographic structure of India is very attractive. There's 400 million millennials in India. So there's more Indian millennials than there are Americans. And again, that demographic doesn't get very much attention. So the demographics of India are very attractive, and it creates a structural growth story. And since 2014, Prime Minister Modi in India has been doing some really impressive policy implementation. So they did demonetization, which was this plan to change all the money to try to route out black money from India. And this was not Modi's intention, but all these people had money under the mattress at home, and then demonetization meant that they had to take it to the bank and change it for the new notes. Once it was in the bank, no one took it out of the bank and put it back under the mattress. They just left it in the bank. And a lot of that money has flowed into Indian equity markets in the last year. So as you can see in this chart, India was one of the only emerging markets that was up last year. And it was actually one of the only markets, full stop, that was up last year. And that was largely because the domestic funds flow is a very important factor now. The other thing that we like about India is that there's significant underpenetration in core sectors. So many of you would probably hold an Australian bank in one of your portfolios. They're getting no loan growth, like literally no loan growth, very little EPS growth. Some of the banks I invested in India are getting 20% loan growth. We own Bajaj Asset Finance, which is a consumer finance company. It can consistently get 25–30% loan growth because penetration of financial products in India is so low. Another company that we like and are looking to buy more is Maruti Suzuki. So it's the largest passenger vehicle company in India. And again, there, if you look at vehicle ownership in India, but what's going to happen when those 400 millennials all wanted to buy a scooter or a car, there's a really long runway in terms of growth for consumer products and auto ownership in India. India is a country that we continue to like. There is an election coming up in May, which some of you may know. My base case is that Modi will return as Prime Minister and BJP will still be the party in power, probably with a reduced majority or possibly a minority. At this point, I don't think that Congress will get in, but that's just something to keep in mind for what's happening in India this year. Okay, I'll talk a little bit about China A shares. So the Chinese market, we break into 3 different markets. One is the Hong Kong shares, which are 8 shares. These are Chinese shares that trade in Hong Kong. And then there's the Chinese ADRs. This is like Alibaba and Baidu, Chinese stocks that are only listed in the US, and they trade as ADRs. And then there's A shares. These are Chinese companies that trade in China, so either in Shanghai or in Shenzhen. And as you may remember, for many, many years, MSCI did not include A shares in its indices. And it's really strange, right? The second largest economy in the whole world doesn't have their domestic share market in MSCI indices. It didn't make any sense. But MSCI had all these criteria, which they thought China had to meet before they would let them into MSCI indices. And China has systematically gone through and ticked a lot of those boxes. So about a year and a half ago, A shares were included in the indices for the first time. But China didn't just put them in at full factor and say, okay, we're going to market cap weight all your companies and this is your weighting. They have this factor inclusion index, so it goes 5% and then it'll increase over time till it gets to the 100%. So the first batch was just 5%, which was actually very small. At the end of February, MSCI is going to make a decision on whether to increase that from 5 to 20. We feel very strongly that that's going to go to 20, and that's going to have a lot of passive inflows, if not active inflows, into China A shares. So this is primarily still off benchmark for us, but we're a benchmark independent fund, so I can definitely go off benchmark if I want to. So we own quite a lot of A shares. Wuliangye, which is a white liquor, Baijiu, for those of you who've been to China, company. Very inexpensive, very strong growth. Hikvision, which is a surveillance company and an artificial intelligence company. Ofilm, which is part of the Apple supply chain, and Medea, which is a white goods company which also has a robotics angle. So Shanghai Comp was the worst performing market in Asia last year. It was down over 25%, and these valuations are very attractive. None of these companies export anything, so we call them our babies that got thrown out with the trade war bathwater because they don't export anything, but they just went down because people were anti-China. So we think that there's a big opportunity coming up in A shares. Okay, so I'll just talk a little bit about the Aussie dollar. I was saying to some people last night, I had this chart in our roadshow last year, and we did a dry run, and people were like, take that out. It's too complicated. It's giving me a headache listening to you talk about it. So I'll try to keep it simple, but given where the Aussie dollar may be heading, it's actually quite important that people understand how it would impact an Asia portfolio like ours. So the main point is that we're an unhedged portfolio, and the benchmark and our fund are denominated in Aussie dollars. So as you know from investing overseas, full stop, if the Aussie dollar goes down versus wherever you've invested, then that's a positive translation effect when you bring your money back. But in Asia, it's not quite as simple because it depends why the Aussie dollar is depreciating, what the impact will be on our fund and the absolute return of the fund. So if the Aussie dollar depreciates, because of a strong US dollar, as we've discussed before in the context of strong Aussie dollar in emerging markets, that's not going to be great for this portfolio because we may gain on the translation effect coming from Hong Kong dollars and other Asian currencies, but it'll be a bad market for emerging markets, and so that'll be a mixed effect. If the Aussie dollar is weak because China is weak and there's lower demand for commodities, that's definitely not going to be good for this portfolio because 54% of it is in Hong Kong, China. So again, we would gain some absolute return on the positive translation effect, but we would lose much more in the fact that the Chinese market would be going down. But what about a scenario where the Aussie dollar is weak because of weakness in the domestic Australian economy? This could be a very positive thing for this portfolio. Not a positive thing for Australia, not a positive thing for some of your other investments, but for this portfolio, it would be a very positive thing because your Aussie dollar would go down. There's nothing wrong with any of the Asian economies. It's not because the US dollar is going up. It's because of weakness in Australia. So you just get that whole translation effect. So to put some numbers behind this, which will make it very easy to understand, Last week with the RBA decision, the Aussie dollar fell significantly in one day. It was about 1.4%. And it was Chinese New Year, so all Asian markets were closed. So my fund was up 1.4% in one day, even though all my markets were closed. So that's the sort of power of the Aussie dollar falling. And if you have a view that the Aussie dollar is going to 65 or, low 60s, it's something to keep in mind for a portfolio like this, where you'll get that benefit in terms of the absolute return. Okay, so I'll just talk a little bit about how I'm positioned for the outlook that we've discussed previously. This is a benchmark independent fund, so we don't hug the benchmark or try to track what's going on. It's based on our process. That's how the portfolio is designed. So in terms of country allocation, China is by far the biggest overweight. Because China was one of the worst performing markets last year, there's a lot more opportunities there than there are in some of the countries that held up well. India, as I mentioned before, is a big weight. We do have some positions in Korea and Taiwan, but they're almost exclusively in technology. And the reason is we are a growth fund. We're only looking for companies that have high growth. And Korea and Taiwan are primarily developed economies. So it's much harder to find a high growth company in Korea than it is in India or Indonesia, for example. But there are some very good tech companies in Korea and Taiwan. And so in Korea, we own companies like Samsung and SK Hynix, which we recently bought. And in Taiwan, we own companies like TSMC. And then in ASEAN is actually a relatively small part of our portfolio. We do like the Singapore banks. These are very high quality banks which got sold off last year and now trading around 1 times price to book, 10 times PE. So the valuations are attractive and their growth is intact. We do own 1 stock in the Philippines and 1 stock in Indonesia, but nothing in Thailand or Malaysia. In terms of sectors, we do have a lot in financials. Financials in Asia, I think, they're very well positioned because they have high growth, but they have low PEs and very low price to book. So it's a good combination of high growth and lower value. Tech is a very important part of the portfolio, and consumer. We typically don't have a lot of exposure to commodities in this portfolio for a number of reasons. One is they tend to be more cyclical and they often don't meet our growth criteria over the cycle. Secondly, our portfolio ends up having very asset light, high cash, high free cash flow companies, and some of the commodity companies don't fit in that category. And lastly, we've heard feedback from investors saying, I'm not going to Asia to buy commodity companies. If I want commodity, I'll buy some more BHP here. So our portfolio fits nicely in that from a diversification perspective. In terms of our top 10, as I mentioned before, Tencent is the largest stock in this portfolio. Because we are benchmark independent, I can have anywhere up to around 15% of the portfolio in Tencent. So Tencent is a company which has captured the attention of Australian investors, and I get a lot of questions about it. It sold off quite significantly last year. I think the peak before the sell-off was about 450 Hong Kong dollars, and the trough was about 250. So we bought some more below 300, and we're happy with our position. Alibaba, as you know, is the largest e-commerce company in the world, and there had been some concern last year about slowdown in the Chinese consumer, but Alibaba just reported a few weeks ago, and the results look strong, so we increased our position in Alibaba. Ping An Insurance is a very interesting company. It's called Ping An Insurance, but it's actually a fintech company. Ping An Insurance, someone was asking me last night, and why are they actually considered a tech company? And they have over 150 million internet customers, financial internet customers, which is an amazingly high number. And they have a system that's built into their business model, which uses the internet and uses technology to sort of capture their customers. And so in my view, it is a tech company, but it's still trading at insurance type multiples. And I think over time, that's going to change. Hong Kong Exchange is maybe the last one. I won't go through this whole list. Hong Kong Exchange is a company that I really like because as China opens up, whether it's MSCI or liberalization of the capital account, all this opening up that's going to happen in the Chinese financial system over the next few years, Hong Kong Exchange sits right in the middle of it. It's a monopoly position, the only exchange in Hong Kong. And all those flows that are going in and out of Chinese and Hong Kong stock markets pass through Hong Kong Exchange. So that's one of our top picks also. I'll just talk very briefly about performance. So performance has picked up significantly in the last 6 months. The low was, I think, at the end of October, and Asian markets have done very well in the last few months. In terms of our NTA, the pre-tax NTA is around 108, and we have an option expiry coming up. So this chart is just showing versus our peers. So we did outperform our peers by about 300 basis points last year, And our stock is still trading at a discount, whereas some of our peers who we've outperformed are trading at a premium. We do have option expiry coming up at the end of February. There's about 60 million options outstanding. And we think this is a great time for investors to be exercising their options or to be getting into the stock because, as I've mentioned, it's going to be a good year for Asia. And the stock is trading at a discount to its NTA. We think the Asian markets have already started to rebound, and this is going to continue for the rest of the year. Ellerston Asian Investments is positioned for this upturn. We are very low cash, less than 3% cash. So typically since the fund started, average cash has been around 8%. So the fact that I'm 2.8% cash is a very big call that the market is going up. We're overweight the two largest economies, China and India, and we're overweight all the mega cap tech stocks, Tencent, Alibaba, Samsung, and TSMC. So with that, invest in Asia now, and I'll turn it over to Q&A. Thanks very much.